Folks, Tom Lee has a loud message for you. Buy these 3 stocks and you will get rich. Filthy rich. Well, he didn't say those exact words, but I'm paraphrasing. If you followed Tom Lee's predictions at all, you know that he's super bullish on small caps, and he just came out a couple days ago on CNBC, and he said that he sees small caps gaining as much as 50% in 2024. He said the recent CPI report gives the green light for the rally to continue, and he thinks the rally will far exceed last year's October to December 27% growth. Now, if small caps are set to rally 50% in 2024, well, that means that many individual small caps will go up some hundreds of percentage points. And so, thus comes the opportunity for us greedy traders. And in today's video, we are going to break down his latest predictions and the reasoning for them, and then we'll break down 3 top stocks to benefit from this small cap trend. And as always, if you're the one taking the risk, you got to be the one doing the ultimate frisk. Make sure to do your own research on all ideas presented. And today's video is brought to you by our absolutely free email newsletter report. A large company just bought a big stake in a small mystery startup, and we believe it's worth knowing about, and we believe it's a ticker that might do a big rallyito down the road. And if you'd like to get our full report emailed to you immediately, well, go ahead and sign up to our email list with that first link down below. Okay, folks, so I want to start today by showing you this chart. This chart here shows that small cap stocks have not been this undervalued relative to large caps since the dot-com bubble. A combination of large caps getting almost all of the capital and small caps barely budging upward after being decimated in the years past has led to this insane disparity. Now, Tom Lee thinks this is a huge opportunity, and in fact, if you look at the biggest drivers of overall indices, well, just a handful of tech mega caps are responsible for the majority of gains seen this year. Quote, we have small caps even more oversold in valuations, whether you look at median PE, which is now at 10 times 2025 earnings, even lower, fund strats, Tom Lee told CNBC. So we think that this move could be something like 10 weeks and as much as 40%. So I think it is just starting. I think that August is really going to be one where the rotation becomes more evident. And I think it's going to be stronger small caps and maybe flat, just slightly down for the S&P. Now, for those of you who are with us during the 2020 and 2021 era bull market, originally the biggest mega cap stocks attracted all of the capital, especially the FANG stocks, but then they got super overcrowded and you started getting more and more money flowing into the smaller cap sectors in search of a greater return. And folks, if you know, you know, when small caps run, they really run. Stock after stock saw hundreds of percentage points of gains, and that's really what led to the original big YouTube finance boom as well. But anywho, not to get distracted, Tom Lee sees this situation happening again. If you look at the small cap versus large cap leadership cycle and you plot them on a chart, this is what that looks like. The chart goes upward when small caps are leading and then downward when large caps are leading. From 1931 to 1983, we had regular cycle alternations between small caps and large caps, but since 1983, we've been in an overall period where large caps have largely dominated. Now, why exactly might that be though, Charlito, Grandpa Charlie, Uncle Charlie? Well, for starters, small cap stocks are more economically sensitive and thus often underperform in late cycle environments. Companies like Apple or Microsoft or Meta could survive a apocalypse, right? However, small caps have more leverage. They have a lot more leverage in floating rate debt and are thus way more exposed and dependent on interest rates. Small caps also have a pretty bad reputation right now. They're less structurally attractive, and that's because more low quality companies have gone public within the small cap spectrum in recent years, but not every small cap is garbage. In fact, a lot of them are really powerful and really fast growing companies. And all of these facts have led to what Tom Lee believes is underperformance in the small cap sector that is very unjustified. Lee points out that small cap stocks are currently trading at very attractive valuations, particularly when compared to the S&P 500. He draws a parallel to 1999, a year that marked the beginning of a long period of small cap outperformance, suggesting that a similar trajectory could unfold now. Small cap stocks are projected to experience substantial revenue growth, expected to outpace that of large cap stocks by a significant margin. Specifically, Lee forecasts that small caps will have a 19% growth in earnings per share compared to 12% for the S&P 500. This superior growth potential makes small caps a very appealing buy right now. Okay, in terms of interest rates and leverage, you got to remember, folks, small cap stocks have much higher leverage on average and thus stand to benefit a lot more from declining interest rates compared to their large cap counterparts. We were just talking about how they tend to have a lot more debt and they're a lot more dependent on debt. And thus, when you're in a higher rate environment like we're in, well, you're going to see small caps underperform. However, a potential rate cut that markets are very much expecting to start in September is set to significantly reduce their capital costs, provide them a strong boost to their overall performance, and allow a lot more investment in their business. markets like to factor things in about 6 months to a year ahead of time. So if markets think that you're going to have cuts over the next year and it's going to be substantial, well, small caps are going to price that in far, far in advance. Now, another thing to keep in mind is that since institutional investors have been under allocated to small cap stocks for years, well, that means that once small caps start to begin to show improved performance, well, these investors may start to increase their allocations, driving substantial further gains. This shift in sentiment is seen as a key factor for sustained outperformance. And that is why Mr. Tom Lee believes small caps can gain as much as 50% in 2024. Okay, so then the next question that follows is, what exactly are Tom Lee's favorite small cap stocks? Well, his all-time favorite ticker by mentions, both in interviews and on social media, is IWM, which tracks the Russell 2000. It's basically a way to buy the top 2,000 small cap stocks. IWM is one of the only major indices that hasn't gotten back to its own all-time highs. And with the Fed expected to cut rates soon, you can expect it to surge. It's also cheaper from a PE ratio standpoint than the S&P 500 from the Motley Fool. Quote, the iShares Russell 2000 ETF trades at a price to earnings ratio of just 15.9, excluding companies with negative earnings. That makes it far cheaper than the S&P 500, which trades at a PE ratio of 24.3. Now remember, folks, according to Lee, small caps are projected to outpace large caps substantially in terms of revenue growth, completely destroy them, with expected earnings per share growth significantly higher than that of the S&P 500. So first, you have to mention IWM as the main ticker because he talks about this all the time and he's very, very bullish on it. Now, in terms of individual stocks, well, you have to go over to Tom Lee's criteria. Tom Lee's strategy for picking stocks is very, very public. He tells us exactly what it is, and these are some of the main points that he goes over. Valuation metrics, he focuses on the PE and the PB ratios to find undervalued stocks. He looks at the earnings and revenue growth. He looks at market sentiment and fund flows. He looks at macroeconomic factors like, again, interest rates, inflation, and economic growth. He looks at historical parallels. He uses historical market comparisons to predict future trends. He looks for diversification and market breadth. He looks at sector rotations. He looks at catalyst events. He looks at technical analysis, what the chart has done in the past. He focuses on risk management, and he implements strategies to manage and mitigate investment risks if he's wrong. So which stocks check off all of these different line items? Well, if you look up the IWM index, you can see the top weighted stocks. It starts with 0.46% weight in cash, and then in terms of actual equities, starts at 0.44 weight and then drops further. But the most heavily weighted equity is INSM Insmed Inc. And if you look at the criteria we just talked about, it checks almost all of them. And so thus, this is a top Tom Lee stock if you're judging by what he says publicly and his criteria. It fits all of them, and it fits the granny shots too, which is a whole nother thing we've talked about in recent videos, but we're not going to get into that today. Insmed, INSM, is a biopharmaceutical company with a heart for making a difference in the lives of people with serious and rare diseases. Based in Bridgewater, New Jersey, and founded back in 1988, Insmed is all about developing and bringing to market therapies that cater to unmet medical needs. Their dedication to advancing medical research and providing innovative treatments truly sets them apart. At the center of Insmed's work is Arikayce, a drug specifically designed to treat refractory Mycobacterium avium complex disease. It's a disease in the lungs. This chronic condition is both debilitating and very, very difficult to treat. Approved by the FDA in 2018, Arikayce stands out as the only FDA-approved treatment for this particular illness, marking a significant milestone for Insmed and the patients they serve. The primary clients for Insmed's groundbreaking therapies are healthcare providers and patients struggling with serious, often overlooked diseases. Insmed partners with medical institutions, research organizations, and patient advocacy groups to ensure their treatments reach those who need them the most. Their focus on rare diseases addresses a crucial segment often ignored by larger pharmaceutical companies, highlighting their commitment to filling these vital gaps in healthcare. What makes Insmed really competitive is their robust pipeline for innovative therapies. Besides Arikayce, they are developing brensocatib, a promising treatment currently in phase 3 clinical trials for non-cystic fibrosis. This drug has the potential to reduce inflammation and prevent exacerbations in patients, positioning it as a potential game changer in treating this chronic respiratory condition. The upside for Insmed looks very, very promising. They operate in the high-margin orphan drug market, benefiting from regulatory incentives like market exclusivity and tax credits. The successful commercialization of Arikayce provides a strong revenue base to support further R&D. Plus, if brensocatib gets the green light and hits the market, it could significantly boost Insmed's financial performance and market valuation. Now, what about their competitive edge? Well, you got to remember that the focus on orphan diseases and innovative therapies positions them very, very favorably because it reduces direct competition and enhances market differentiation. Now, looking ahead, several catalysts could drive Insmed stock higher. Key clinical trial results, regulatory approvals, and potential partnerships or acquisitions are all on the horizon. The results from the phase 3 trials of brensocatib are particularly anticipated and could significantly impact the stock and do a rally-ralito. Moreover, new regulatory approvals or label expansions for Arikayce could further strengthen the company's market position. Now, as you go down the concentration list, there's another interesting one that stands out quite a bit, and that is FN for Fabrinet. Fabrinet is a leading provider of advanced optical packaging and precision optical, electromechanical, and electronic manufacturing services to original equipment manufacturers, also known as OEMs, of complex products. Established in 1999 and headquartered in Thailand, Fabrinet serves a broad range of industries, including communications, industrial, automotive, and medical. The company's mission is to deliver high-quality, cost-effective manufacturing solutions that enable their clients to innovate and thrive in competitive markets. Fabrinet was founded by Tom Mitchell, a pioneer in the optical and electromechanical manufacturing industry. The company has grown significantly since its inception, expanding its capabilities and geographical footprint. Fabrinet's core competencies include precision manufacturing, complex optical and electromechanical assemblies, and comprehensive supply chain management. Now again, Fabrinet's clients are primarily OEMs in the communications, industrial, laser, automotive, and medical device spaces. Some of their notable clients include Cisco, Lumitum, and Jupiter Networks. These companies rely on Fabrinet's expertise in manufacturing complex optical and electronic components to maintain their competitive edge and meet the stringent quality standards of their respective industries. Fabrinet's competitive edge lies in its ability to provide high precision manufacturing services at scale. The company's expertise in optical packaging and precision assembly is unmatched in the industry. Additionally, Fabrinet's vertically integrated manufacturing processes allow them to control quality and cost effectively. Their strategic location in Thailand also provides a huge cost advantage, enabling them to offer competitive pricing without compromising on quality. Now, in terms of market potential, the market potential for Fabrinet is substantial, driven by the increasing demand for optical communication services and systems, industrial lasers, and advanced medical devices. Now, there are several catalysts that could drive Fabrinet's stock higher in the coming years. Key among them is the increasing adoption of 5G technology, which is expected to significantly boost demand for optical communication systems. Additionally, the growing use of industrial lasers in manufacturing and the rise of advanced medical devices present significant opportunities for Fabrinet. Fabrinet is actively pursuing expansion opportunities to strengthen their market position and enhance their capabilities. The company is investing in new facilities and expanding their existing operations to increase production capacity and meet growing demand. Fabrinet is also exploring strategic acquisitions to diversify their product portfolio and enter new markets. Analysts also have some pretty damn high price targets for the company. And so anyways, in conclusion, with analysts projecting significant upside and several key catalysts on the horizon and a pretty strong financial history, Fabrinet represents a compelling buy for those looking to benefit from the growing demand for advanced manufacturing solutions. Anyways, there you have it, folks. Tom Lee's bullish outlook on small caps with his prediction of a 50% surge in 2024 certainly makes a compelling case for taking a closer look at the sector. Anyways, let us know what you think about the stocks down below. Do you think Tom Lee is right or wrong? Let us know down below, and don't forget to check out our free email newsletter for more detailed reports and updates on potential game-changing buys. And as always, if you found this video helpful, make sure to hit that ravishing like button and subscribe, and we will see you in the next one.